Logistics and haulage businesses don't fail because they lack work, they fail because margins get squeezed. In this video, I explain how business loans work for haulage companies in the UK and where finance helps versus where it just papers over problems. Fuel, vehicles, maintenance, and staffing leave little margin for error. Borrowing can stabilize cash flow, but it won't fix low pricing or structural margin issues. General information only. Let's start with the basics. Development finance is designed to fund the cost of building or converting property, not just buying it. That usually includes land or purchase price, build costs, professional fees, and sometimes interest rolled up over the term. Unlike standard mortgages, development finance is short-term and project-driven. The first thing lenders care about is the project itself. They assess the gross development value, or GDV, the total cost of the build, and the expected profit margin. Most lenders want to see a healthy margin, often at least 15 to 20%, because that buffer protects them if costs rise or values soften. One of the ways finance helps developers is speed. Development loans can allow you to move quickly on opportunities, secure sites, and progress projects that would otherwise take years to fund from cash alone. Used correctly, leverage can increase returns and scale a portfolio, but this is also where problems start. High leverage increases risk. Development finance is expensive compared to traditional borrowing. Interest rates, arrangement fees, exit fees, monitoring costs, and valuation fees all add up. If those costs aren't built properly into the appraisal, profit can disappear quickly. Another major issue is cash flow pressure. Development finance is usually released in stages, known as drawdowns. That means you need enough cash to start works and cover gaps between inspections. Developers who underestimate this can end up stuck mid-project, scrambling for funds or injecting personal cash unexpectedly. Timing is another area where loans can hurt. Development finance is short-term, often 12 to 24 months. If a project overruns due to planning delays, material shortages, or contractor issues, interest continues to accrue. Extensions are possible, but they usually come at a cost. A delayed exit can turn a profitable deal into a marginal one. Exit strategy is critical. Lenders want to know how the loan will be repaid, sale, refinance, or a mix of both. Weak or unrealistic exit plans are one of the most common reasons development finance applications are declined. Even worse, developers sometimes secure funding but haven't properly thought through whether refinancing will actually be achievable once the project is complete. Another mistake is using development finance when bridging or other funding would have been more appropriate, or vice versa. Applying the wrong type of finance adds unnecessary cost and complexity. Good funding supports the project, it doesn't dictate it. So when does development finance genuinely help? It helps when the numbers are realistic, margins are strong, costs are properly accounted for, and there's a clear exit strategy. It helps when finance is used as a tool, not a crutch, and it helps when the funding structure matches the project timeline and risk profile. When does it hurt? It hurts when leverage is too high, margins are thin, contingency is ignored, and optimism replaces planning. It hurts when developers chase funding without fully understanding the true cost of capital. The takeaway is simple. Development finance isn't good or bad on its own. It's powerful. And, like anything powerful, it needs to be used carefully. If you found this helpful, subscribe for more straight talk videos covering property finance, development funding, and common mistakes investors and developers make. And if you want to explore funding options for a specific project, you can find more information via the links on the channel. Thanks for watching.